Hello, I'm Steve Balch, the Director of Wealth Management and Financial Planning at Certa Financial Planning, here to give you our monthly market update for May. Here's our latest macro update, including two key downgrades to our outlook this month. We're shifting our view on the market trend to neutral. April began with early volatility, but recovered most of the losses. Still, after 3 consecutive down months, and with the indices still below all-time highs, we've moved to a more cautious neutral stance. The Fed policy stays neutral. The Fed held rates steady at the May meeting. Inflation data continues to soften, but the Fed remains cautious. Right now, markets show a slim majority expecting a rate cut in June, but that's far from a certain. Fiscal policy was also downgraded to neutral. While government spending has remained steady, ongoing uncertainty around tariffs and other policy shifts have added noise to the market outlook. Leading economic indicators remain neutral as data remains mixed. Inflation is coming down, job growth continues to be strong, and retail sales jumped in March. However, sentiment has dropped for 4 straight months and wage growth is slowing. Lastly, valuations remain neutral. Large cap US stocks are still trading at elevated levels, where international equities, particularly in developed Europe and emerging markets, appear more attractively valued and have outperformed year to date. Today's environment reflects a mixed market regime. On one side, easing inflation and softening growth point to a deflationary tilt. On the other side, strong labor markets and resilient earnings support a reflationary case. These conflicting signals keep our risk-on, risk-off metric in neutral territory. As we enter quarter 2, economic data suggests we're somewhere between the mid and late stages of the business cycle. Growth is slowing, inflation is easing, and corporate earnings remain strong, but forward momentum is less certain. The labor market is still healthy, but cracks are starting to show in consumer sentiment and leading indicators like GDP. This stage often calls for more selectivity and risk management, as markets tend to become more sensitive to policy shifts and surprises. There are 3 questions we're monitoring. What letter recovery will we get? Will it be an A? Will it be a V, a W, or a U? Are there concerns over economic growth? How will tariffs impact corporate earnings? The market dropped sharply in April, and now everyone's asking the same question. What kind of recovery can we expect? A V-shaped recovery is the best case scenario. It's a sharp decline followed by a fast rebound, just like the COVID crash in March 2020, when markets fell over 30% but recovered quickly by August thanks to stimulus and rate cuts. A W-shaped recovery is more volatile. It means we bounce back only to drop again before a lasting recovery. We saw this between 2015 and 2017. Rising oil prices, global growth fears, and policy surprises led to repeat ups and downs. Then there's the U-shaped recovery, slower, more drawn out. Think early 2000s after the dot-com bubble. It took several years before the market returned to their previous highs. With today's mix of high valuations, policy uncertainty, and uneven data, a clean V-shaped recovery looks unlikely. That's why we stay diversified, balanced, and focused on long-term planning, so you're prepared no matter which path the markets take. US GDP contracted by 0.3% in the first quarter of 2025, the first negative reading since early 2022. But before jumping to conclusions, let's look at why it happens. Imports surged as businesses rushed to buy goods ahead of new tariffs. That subtracts from GDP, even if demand stays strong. Inventory restocking slowed after big buildups in prior quarters, which pulled growth down. Consumer spending is still growing, but at a slower pace, especially in goods, as inflation and interest rates weigh on households. What does it all mean? One negative quarter doesn't mean we're in a recession. Jobs are still strong, wages are stable, and inflation is cooling. This looks more like a slowdown, not a collapse. Corporate earnings continue to be a key pillar holding up the market, especially with economic signals sending mixed messages. So far in 2025, results have surprised to the upside, especially in large cap tech. Companies are showing strong cost controls, stable margins, and continued revenue growth, even with slower GDP and rising cost. Earnings for the S&P 500 are expected to grow 7 to 10% this year, with projections between $245 and $268 per share. But here's the catch. Most of that growth is coming from just a few mega cap tech names, often called the Magnificent Seven. The market's trading at about 20 times forward earnings, well above the long-term average. That means a lot of optimism is already priced in, and there's little room for disappointment. If those tech names stumble, or if AI or margin expectations fall short, we could see renewed volatility. That's why the risk of a W-shaped recovery is still on the table. Looking ahead, May has been historically a strong month for the markets, positive in 9 of the past 10 years, and is often one of the best performing months during the first year of a presidential term. Early signs this month point to improved stability with encouraging earnings results, and a steady labor market helping to ease concerns after April's volatility. That said, we remain cautious. Headwinds persist, from mixed economic data and uncertainty around Fed policy and tariffs to elevated equity valuations that leave little room for error. In short, the path forward is likely to be uneven. As always, we're staying focused on the data, disciplined in our risk management, and committed to strategies that balance long-term opportunity with downside protection. We'll continue to monitor developments closely and adjust positions as needed to keep our clients aligned with their goals. We thank you for watching. If you have any questions, feel free to reach out, and please feel free to forward this to anyone you believe can benefit.